So here is the truth. You can keep waiting for some break of structure, or you can move like the institution. Retail waits while we trade. While they wait for a textbook break of structure, we're already in, confirmed with a delta flip and validated with order flow. So welcome to the Sniper's Lens. This is not a game of guesswork. This is top-down analysis with the footprint chart. And we are starting with the 4-hour time frame where the institutions leave their fingerprints. So you've heard the trend is your friend, but what if I told you that most traders still enter against the real move of the day? Why? Because they skip the top-down context. Today I'll show you how the pros use the multi-time frame analysis, from the 4-hour to the 1 hour to the 15-minute and even to the 5-minute or even the 1 minute. On the footprint, to lock in sniper entries, to lock in sniper directional bias with 90% precision. And then also, I'm going to show you live chart breakdowns of each and everything so that you can have a clear understanding of each and everything. Let's get into it. So first things first, why does top-down analysis matter and why is it important? Most retail traders scream top-down analysis. All they do is draw support and resistance lines on 5 charts and still have no idea where the price is actually going. So what is our difference? We are not chasing price. We are tracking and confirming points of interest. And these points of interest, we have order blocks, unmitigated wicks, breaker blocks, fair value gaps or FVGs or imbalances. So these are not just lines, these are traps. And if a point of interest is sitting at a high, we are looking for shorts, and then if a point of interest is sitting at a low, we are looking for longs or we are looking to buy. Simple, intentional, and precise. So let's get into the flow of each and everything. If we have the 4-hour, we get to the 4-hour, the 15-minute, or up to the 5-minute time frame. As day traders, our battlefield is tight, but the intel comes from higher ground. So here is the hierarchy. If price taps into a higher time frame point of interest, confirmation comes from 15-minute and then down to maybe the 5-minute or the 1 minute for the entry. Why I say 5-minute or 1 minute for entry is that we might not need the 5-minute or the 1 minute for entry if we are coming from a very high point of interest, like maybe the 4-hour or the 1 hour or even the daily. But note and listen carefully. The third time frame, I'm talking about the 5-minute, the 3-minute, and the 1 minute time frame. When you're doing this top-down analysis, you really have to be strict with those small time frames, because these lower time frames, 5-minute, 3-minute, 1 minute, have a lot of noise. They're a little bit noisy sometimes, and sometimes they have a lot of noise. But still, even if you do your top-down analysis with 2 time frames, you would be more accurate than 95% of the traders. So for the lower time frames, maybe 1 minute, 3-minute, 5-minute, we might just need them for a higher risk to reward ratio. But the higher the risk to reward ratio, maybe if you've been having maybe a 98% win rate, the higher risk to reward ratio, and the lower you go in the time frames, is the more the win rate will reduce a little bit. So you might go from maybe 98% win rate to maybe 90% win rate. That is not a problem if your psychology is okay. Some of these things you have to use a little bit of logic. If you're going to these lower time frame, maybe 5-minute, 3-minute, 1 minute, if the size of the point of interest, even if it was from the 15-minute or the 10-minute time frame, if it is very big, you have to know that if you go to the 1 minute time frame, you're going to be messed up. So why then would you use the 1 minute time frame for a very big POI or for entry confirmation, yet you know there are going to be very many candlesticks in that point of interest because it is big and there was a lot of activity that was happening there? So we can only do that if that time frame actually and realistically looks small and fit for the third time frame. So if it is the 1 hour point of interest, the confirmation drops to the 5-minute time frame. If it's the 15-minute point of interest, the confirmation, we get it from the 1 minute time frame. And if it's the 4 hour, we get it from the 15-minute time frame. If it's the daily point of interest, we get our confirmation from the 4 hour time frame. But then the other hierarchy of confirmation is not to skip the major time frame in the middle. We can also do 4 hour, 1 hour, 15 minute, 1 hour, 15 minute, 5 minute. Daily time frame, 4 hour, 1 hour, like that. So if it's 15-minute point of interest, 5 minute, 1 minute, like that. But what is the actual confirmation? Delta flip, delta surge, delta transition. As we saw in the previous videos, when you move from the point of interest time frame, the time frame where you've gotten your point of interest, and then you move down to the confirmation time frame to confirm the direction of the shorts or the long, that is when the footprint will come in to help you with this analysis style. The delta surge, delta flip, delta transition, I broke them down in the previous video. So if you might be confused about the terms I'm using here, just know 90% of everyone watching this video is not confused. So you have to go back and watch those videos so that you as well on the same track with us. They are the DNA of real confirmation and real volume in the footprint chart. So you see that red candle, retail will think it's a sell, but unless there is aggressive shift in delta, that is just paint on the wall for us. We do not consider a red candle as sell, or we don't consider a buy candle as buy unless we've seen through it with our X-ray vision. Retail is taught to wait for break of structure and change of character to confirm a point of interest. Liquidity sweep confirmation, liquidity that they can't even see. Imagine liquidity that they can't even see. They just guess that there is liquidity here, and then they'll be like, the liquidity has been swept. Liquidity there, they can't even see. So that is what retail is taught. But by the time their MACD crosses or their moving average crosses, price has already dumped like 40 pips or 10 pips or even 50 pips to 100 pips by the time they're looking for entry. We do not need a change of character. What we need is a delta flip, delta surge, and a delta transition. A delta flip to show us the trapped buyers or the trapped sellers losing the war, or a delta surge to confirm institutional aggression to the other side, or a delta transition to confirm weakness of the other side and strength of the other side coming in. And then after that, we strike. So while the retail is still drawing boxes and waiting for trend line breakouts, we are already deep in profit. So the other important thing is, when price taps a POI, leaves and comes back more than 3 times, that could be a trap. So we invalidate that kind of point of interest, because our moves, if market makers are done trapping and manipulating, they move immediately. So if you start seeing something like a consolidation, you might get trapped there. So you just let that point of interest go. As part of your rules, you just have to be disciplined and know that this is not the kind of trade I want to get into. So right now I'm going to take you through the examples of how we did the top-down analysis and got a very clear directional bias. This time I only got one before trade. Like I only managed to capture the before of only one trade before it happened, but then the other trades are, some of them are on GBPJPY and then the others are on GBPUSD. So I'm going to take you through faster, then we can see, so that you can also go and try it out and make some money. So the first one, I'm going to start with the trade whose screenshot I have before it happened, and it's right here. It's right here. This is the trade. It happened on 17th July. So I'm going to go to trading view and then also Sierra and show you how we confirmed this direction, this trade. So first of all, this point of interest for that trade was this unmitigated wick First of all, I'm going to first take you through the points of interest that I mentioned. The first point of interest that we talked about is the order block. And we all know what an order block is. An order block is the last bearish candle before a bullish move, or the last bullish candle before a bearish move. So if we have this is our order block. And then also, if we have this right here, it's also our order block, because it's the last candle, it's the last bullish candle before price went down. And also maybe this one, it's the last bullish candle before price went down. Even this one, last bullish candle before price. But for me to truly confirm an order block, it has to have left some sort of FVG here in between. So if there's something like that, then I consider that order block very, 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 very valid. Yeah, something like this. I consider that a very valid order block if it leaves some space between these two candlesticks. Yeah. So first things. So let's get into the actual thing that I wanted to show you. Okay, those are the order blocks. So the next one is the unmitigated wick. The unmitigated wick also has to be a wick of a candle at a high that was not tapped into. So that's what mitigation is, when price comes back to a certain area. But when price doesn't come back to that area, that means there was no mitigation actually there. So this one, we cannot consider it an unmitigated wick, because this candlestick came back and tapped into it, so it's not unmitigated. This one was unmitigated, and then also this one was unmitigated. Yeah. Then for the breaker blocks, it's just a failed order block, just like you see here. This is a failed order block right here. So this becomes a point of interest when price comes back to this level. I'm going to look for an order block that a breaker block that actually worked out. But we all know what an order block is, because I'm very sure if you're on this page, you're not a beginner. So those are the points of interest. Then the FVG is just this imbalance right here, this space between this candle and this candle, the space that is left in between here, that's the FVG. Also here, the space left between here and here, that's the FVG. And most of the time, when you look at the footprint chart, you can see imbalances inside such candlesticks or inside such spaces. That's why price reacts from there. Sometimes, as you can see here, price reacts from such zones. As you can see, it reacts from such zones. So anyways, let's get into the examples. So this one was on the 4-hour time frame, and we said if we move from the 4-hour time frame, we can go to the 1 hour or the 15-minute. But in this very example, we moved to the 15-minute. And then when you go to Sierra charts, there's this time when price came and tapped into this level. You see, price came and tapped into this level the first time. This was at around, let's see, 22:45:16. Yeah, this is so this chart is in New York time. It is in New York time, but by that time, when it was at around midnight New York time, in Uganda it was around 7 a.m. So that's clearly Asian session. But for me, I don't follow the session timings most of the time, because those are myths. So I trade when I get the opportunity. So we want to look at this chart from exactly where price tapped into this zone. And you can see when price tapped into that zone, we started looking for what? Either for our 3 setups on the 15-minute time frame. Remember, we got the setup on the 4-hour time frame. Yeah, so I mean, we got the point of interest from the 4-hour time frame. So we had to go down to the lower time frame and look for a confirmation with our 3 setups. And then right here, as you can see, we got we got a delta flip right here at 0.15, 0.30. We had this delta came in very strong for the sellers, and then it came in very strong for the buyers, meaning the sellers were trapped right there. So after getting in, so right here we got in. I usually don't take I usually target the nearest imbalances or the nearest liquidity, and right here we had some imbalances right here. They were my target. And of course, I told you, when you're entering such setups, you put your stop loss slightly below the trap candlestick. So here, after getting our setup, here after the candlestick that trapped, or the candlestick that confirmed the delta flip, after it closed, we got in and then we put our stop loss slightly here. We targeted these imbalances that were here and we got a 1 to 5. This was a 2 pips stop loss and a 10 pips take profit. But again, we still had a lot of liquidity here, and this really confirmed that price still had to go up there. So I was like, my rule of this POI being hit more than 3 times has not yet been met, so I'm still going to get in. And then when price came back here for the second time, we went back to the footprint chart to confirm again. So as you can see right here, we got a delta surge. We had 246 delta, and then it switched to 204. The delta kept on increasing and increasing, giving us our delta surge, and then we got in at 315 right there. Stop loss right slightly below these candlesticks that formed the delta surge. We got in 23 pips stop loss, and then our take profit, targeting this liquidity that was here. You can check out with the order book heat map if you know how to use it. There's a lot of liquidity sitting here, 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 and here. So that was our target. And what happened? Price actually went to that exact zone. But you can see that we confirmed this point of interest with the footprint chart, and you can see how strong it is. So the next ones, we are going to go to GBPJPY. GBPJPY, we also got these points of interest on the 4-hour. I had to use the 4-hour because I mostly trade gold, so I didn't want to spend a lot of time looking at the chart, yet I also have to look at the trades that I have to send to my Signal channel. So right here we had the order block. Let's start with this one or this one, because this one happened before. But then also here we had this. We had all these points of interest. We had this one, this order block. We had this unmitigated wick. We had this order block. We also had this order block here. But then when price came and tapped into this order block right here, straight to the 15-minute time frame, this was on Wednesday, 23rd July, 2 a.m. New York time. In Uganda, that would be like 9 a.m. Frankfurt open. So we go to GBPJPY, 2 a.m. Yeah, so you can see that price came and tapped into this point of interest once. It didn't confirm the entry here, and then still you had to wait, and then we got in right here. So by the time so price came back, and then it still took out this high. Someone might enter from here. Maybe they've seen maybe market structure shift on maybe the 15-minute time frame, or I mean on the 5-minute time frame. Maybe they've seen a change of character or something like that. They get in from here and then they get stopped out, and then the institutions load in positions. So it is not ideal for you to confirm these trades blindly, because maybe you've seen a change of character or a break of structure. That is how you get stopped out, and after getting stopped out, the institutions continue with their move. So right here at around 1:30, that is when we started looking at our chart for confirmation of our trades. Right here at 2, we had a delta flip. We had these aggressive buyers coming in and price shifted immediately. You can see that 166, the max delta is close to 166, and then the mean delta is close to 0. Then you can see here the mean delta came in strong, and then also the delta came in strong, and then the max delta being close to 0. And then also the delta percentage, you can see the delta percentage was stronger than the previous delta percentage. We got in for our sales, sniper entry, 0 drawdown, straight to this point that had our liquidity. And then we got our 1:5 risk to reward ratio. So by the time also some other trader is waiting for this change of character to happen, we already got in, of which sometimes you've seen that most times it doesn't happen. So by the time you're waiting for the change of character to happen and then price coming back to maybe your 50% level of the Fibonacci, we entered from the high, you get. So some of these things are even really very funny. And you can see that also the points that we target, that is exactly where price reverses from and comes back down, because we have the blueprint, we have the x-ray that other people do not have. So the next trade, our point of interest was the unmitigated wick. Right here, we waited. When price taps into the point of interest, just go back to the lower time frame, the corresponding lower time frame, and look into it and wait for just 3 setups. If it doesn't happen, move on to the next trade. Simple. So when price came and tapped into this zone, that was on 30th July, 23 hours or 11 p.m. New York time, we came to our Sierra chart on the 15-minute. Remember, the point of interest was the 4-hour. So 23 hours or 11 a.m. or 11 p.m. New York time, we had this. Price came and tapped into this point of interest. 23, yes, 23, 30th July. Price tapped into this point of interest, and then we got a delta surge. You can see that buyers came in, sellers came in, because they're the ones pushing price down. So, but then when we reach that point of interest, because we know these unmitigated weak order blocks, they be having some trapped buyers and sellers, depending on the order block or the unmitigated weak or the fair value gap. So they pushed price to that point of interest, but we were expecting price to bounce off that point of interest. But for us, we do not react. We do not enter. We wait for price to show us its intention, and then we react to the intention. So here we had these sellers coming in, they lost control, buyers started gaining momentum. These 3 candles confirmed that we had a delta surge, and now buyers had taken control and taken over. Even the 4th candlestick still confirmed, because price kept on increasing. Because the buyers kept on increasing, you get. So when those candlesticks closed, of course, and then also the other confirmation that we had is that we had absorption here. Price kept on going down, the candlesticks were red, but then price kept on going, but then delta kept on going up. This is what I was telling you. You see here, this candlestick was red. This candlestick was red, but then it had buyers most. It didn't even have any sellers. The buyers dominated this candlestick. Even this one, it was red, but it didn't even have any. It didn't even have any sellers dominating. The sellers were there. They're right here. You can see the max delta was 170, but the buyers dominated it. So looking at the candlestick chart is just playing chess blindfolded, because right here for us we can see that okay, it has printed out to the retailers that people are selling, but here in the footprint chart we can see that people are not selling, but sellers are losing control and buyers are getting in. So you can see right here that was also another red flag, and that is also another red flag you can use. Seeing price going down but then delta is green, or it's positive, or seeing price going up, you can see the candlesticks are going up but the delta is negative. That's a sign of absorption, and that's a sign that price is going to reverse anytime soon. So after we got this delta surge, we bought right here, stop loss slightly below here, and then we targeted this place right here because there was liquidity here, there was lots of liquidity here, lots of equal highs with liquidity here. And then also we had this point of interest. Remember the rules of liquidity, by the way. As soon as liquidity is taken out, price reverses. So this liquidity that was here confirmed this target, but again it confirmed this point of interest to be strong because we knew there was a lot of liquidity to be taken, and after liquidity is taken, price reverses immediately. So right here we had the next trade, or we are going back to the 4-hour time frame. The 4-hour time frame right here, we had this order block. Yeah, and what confirms this order block is that we have this. Also, I'm going to show you in the next videos how to also confirm the points of interest. If you're not the kind of person that is going to be on your chart, there's a way you can confirm these points of interest. You set your buy limits or sell limits, and then you go to work, and then you come back when price already hit your take profits. You get, without having to wait and then confirm. We shall also see that. Right here we had this order block right here, and then when price tapped into this order block, we dived into the lower corresponding time frame, and that was the 15-minute time frame. When price tapped into this 15-minute time frame, that was at around 12 hours or 12 p.m. New York time, 31st July. So we're going to see what happened on 31st July. So right here on 31st July, when price tapped into this point of interest on the 15-minute, we on the 4-hour time frame, we came to the 15-minute, and then we started looking at price from 12 p.m. So we started looking at these candlesticks to confirm what had given us the right entry. And right here we had a delta flip, as you can see here. 12:45, we had this delta and max delta being close to each other and mean delta being close to zero. Then we also had a negative delta being high. Then the mean delta was close to the delta itself, and then also the max delta close to zero. And then yes, at 13 hours we got into this trade. So stop loss slightly above these two trap candles, these two candles that have confirmed the trade for us, and then we get in. So of course the target was the liquidity. We had liquidity here, we had a lot of liquidity here, and it being a past point of interest, it's invalid now. Of course it has to be taken out, so it was taken out right here, and then we got our take profit of 1 to 8 risk to reward ratio. So the reason as to why our daily bias is 90% or close to 95% accurate, it's because it is rooted in points of interest. Our directional bias and top-down analysis is 95% accurate because we use lots of confirmation and we start from the bigger picture. We do not start from the smaller picture, because if you're starting from the lower time frame, maybe you want to start from the 5 minute, how are you going to buy when price is in a very big point of interest? That is telling us to sell on the 4-hour time frame, you're going to be trapped. So it is rooted in points of interest and confirmed with delta aggression, and then it is executed with sniper entries. You've seen that these trades do not have drawdown, it's close to none. So sometimes it's there, but it's close to none, and then also the win rate is high. This is not some trend line touch. This is not some retail trend line touch strategy or Fibonacci strategy. We are reading the actual battlefield, and then we build our daily bias off the real order flow. So it is 85% to 95% accurate. Let that sink in. And that is before we have even added VWAP, volume profile, depth of the market, heat map. You're already having a 90% win rate with just the footprint chart before you even add other things like the volume profile, the VWAP, the DOM, the order book heat map, iceberg order detection, all that. Now, what if you add all those? You're close to a 99% win rate. So if our bias is this accurate and our entries are this clean with just the footprint chart and delta setup, imagine what happens when we drop the full arsenal. So here is the truth. You can keep waiting for some break of structure, or you can move like the institution. So I'm going to drop the PDF cheat sheet of the directional bias and top-down analysis in my Telegram channel. So you will join the Telegram channel, and then you go to the files side. You find the PDF cheat sheet there with instructions step by step of how to do the top-down analysis and find actual directional bias with this analysis style. And if you thought this was powerful, imagine what will happen when we add VWAP zone and historical volume traps. That is next. So here is a recap of how we do the top-down analysis sniper style. Start on the 4-hour time frame. That should be your main higher time frame bias. Look for points of interest like order blocks, unmitigated wicks, breaker blocks, fair value gaps. If price taps into the 4-hour point of interest, you then drop to the 15-minute and then confirm entry on the 5-minute. But that is optional. If it's the 1-hour time frame POI, the confirmation will be the 5-minute. 15-minute will go with 1 minute, and then the other hierarchy that I showed you is 4-hour, 1 hour, 15-minute, 1 hour, 15-minute, 5-minute, 15-minute, 5-minute, 1 minute time frame. So inside those lower time frames, wait for a delta flip, delta surge, or a delta transition, and then strike. If we get it, that's our green light, and that's how we build directional bias and top-down analysis like institution, not retail guessers. So subscribe and turn on notifications, because in the next video I'm bringing a new tool. Let retail cry about manipulation, but for us, we shall just follow the footprints. Try this out and put your feedback in the comment section so that I can have at least morale to bring in something new. So subscribe and turn on notifications, and then I'll see you in the next video.